I am very privileged and honored to have Dr. Joanne Feeney here with us this evening. She is a very close friend, and I'm just thrilled that she took time out of her day to speak with all of us. So, welcome, Joanne. Nice to see you as always.
Thank you, Kelly. Nice to be with you, and hello, everybody. Some of you I think I've probably met when I was out there pre-COVID.
Yeah,
and the rest of you I look forward to meeting the next time I'm out there.
Yeah, I just had some clients today said, oh yeah, I remember meeting her when she was out here. So you are well regarded here. So before I introduce Dr. Feeney here, I do want to share my screen and I want to go over my master proprietary process a little bit with everyone. Can you see that? Does it say master proprietary process, Joanne?
I can't share your screen.
There we go. Is that...
Okay, it's coming. There it is.
Okay. All right, so I want everybody just to remind you where Dr. Feeney and Advisors Capital Management lands in the master proprietary process I have here that I use for everyone to manage portfolios. So obviously M being the market, which is where Dr. Feeney is, A being alternative, any kind of real estate or alternative loan programming, the thing that doesn't travel with the markets over there in the dark blue. And then in the gray section down there is safe investments. So annuities, life insurance, long-term care. So tonight we are going to be talking about this light blue section all evening. So I am again thrilled to have Dr. Feeney here with us. Let me introduce her. I'm privileged to do that. Dr. Feeney is a portfolio manager for Advisors Capital Management, my favorite money manager, and manage the growth and balance strategies. Prior to joining Advisors Capital, Dr. Feeney was a senior equity analyst for over 10 years. She focused on evaluations for nanotechnology, advanced instrument, and semiconductor companies. So Dr. Feeney is a very wise woman, that's for sure. Dr. Feeney worked as a consultant for the World Bank while a founding faculty member at the College of Nanoscale Science and Engineering in Albany, New York. Here she focused on partnerships between leading edge technology startups and major semiconductor players in conjunction with the creation of a $7 billion Center for Advanced Semiconductor Manufacturing led by the Albany Nanotech at Albany and IBM. Dr. Feeney also consulted for the Federal Reserve and the National Monetary Fund. She also works very closely with Dr. Alan Greenspan. So as you can see, you can tell why I admire Joanne so much. She has such a great history and she makes it fairly easy to understand this end of the market and what she does and how she does it. So Advisors Capital, just to remind you all, they buy individual stocks for portfolios. They don't buy a bevy of mutual funds, which is what I see mostly out there with managed accounts. So they stand out for that reason. So I really love that they do that. The costs are much less. They're more nimble. I won't steal your thunder, Joanne, but with that, I think I'll let you take it away. I'll let you share the screen so you can show your slides. And oh, one more marketing note here, or a program note here. If you guys have any questions, you can type them in under the chat section of your screen there. We're not going to make anyone live but me and Joanne, so go ahead and type in your questions as they come up over time, and we'll get to them as we can. So with that, Dr. Feeney, you take it away.
Okay. I'm going to share my screen. You see that?
Yep.
Okay. So, wanted to just get a start on looking at where we are in the market. And where we are, and let me see if I get rid of that. Yeah. Where we are is a whole lot better than where we were about a year ago. I've put up 3 charts here for everybody to look at. SPY is tracking the S&P 500 index. That's the green line here. The RSP I like to show because it gives you a sense of what the average stock in the S&P 500 has done. This is an ETF that reflects the average weight, the weighted average of the S&P. As most of you probably know, when you look at the S&P 500, what you're looking at is a index that is weighted by the market capitalization of all the stocks in the S&P. So bigger companies have a bigger weight. And what you can see from looking at the red line here is that the average stock actually did a lot worse than the S&P as a whole during the period of COVID when it was at its worst last year, and it took a lot longer to recover. But now they're about back in the same place. And this last line here is the high dividend index. These are the top 80 dividend paying stocks in the S&P 500. And so folks that are looking for income in their portfolios, they got hit harder last March and they still haven't fully recovered. This chart starts at the very beginning of 2020. So we're kind of back to where we were at the beginning of that year, but we have not gotten nearly as high as the average stock in the S&P or as that regular old S&P 500. And the reason for this, as many of you probably know, is that there are many stocks in the S&P 500, many companies that actually benefited from the pandemic because people bought more computers, they used the internet more, they ordered online more. And so a lot of the companies in the S&P benefited from that. And so a lot of folks ask the question, hey, is the market too expensive right now? And this, kind of makes it look like it is. This is the price to earnings ratio of the S&P 500. This is forward looking, which is what you want to look at. And it takes a look at what the price of the whole index is relative to the earnings of all those 500 companies 1 year forward, 12 months out. And what you can see is, as of the end of the first quarter, that market was trading at nearly 22 times earnings over the next 12 months. And these dotted lines, this gives you the history of that from 1996. And this shows you that we're pretty far from normal. And so some people are looking at that and saying, hey, boy, it certainly looks like the market's expensive. But you have to even place this in the context, not just of the history, not just of where it was for the last, 15-ish years or 25 years, but you have to actually place it in the context of where interest rates are. And interest rates right now are extremely low. In fact, one of the ways that the U.S. government borrows money is they issue treasury bills, which is short-term loans. And the interest rate that they've been having to pay to get people to lend to them was near zero last Thursday when they issued $43 billion worth of 4-week treasury bills. So very, very short-term borrowing, but it was a zero interest rate effectively. And so when the alternatives for investing give you a zero rate of return, then stocks trading high just reflects that's where people want to put their money right now, because you're getting a much better return, even taking on equity risk, than you have when you can go elsewhere. Now, Kelley offers you some other alternatives that are better. She's got the alternative investments, whether those are real estate, in addition to those safer things. But those safer things, I think that Kelley is offering, right, have some yield built in because they're annuities or something else. But if it's just a comparison of equities versus bonds, then the bond market just isn't offering very much right now. And so it's not a surprise. In fact, it's quite normal historically to see the equity market trading at as high as 25, 26, 28, even 30 times when we're in periods where the interest rates are as low as they are right now.
Yeah, so to your point, to your point there, Joanne, so people come to me all the time and they have $1 million or so of cash in the bank, and they're confused and frustrated with what to do with it because they can't get any yield on that. So a lot of people are going to the market for that. So to your point, and I think that's why a lot of people put, and maybe you're going to mention this, I might be stealing your thunder, but why a lot of people put money into the market last year, because they had the stimulus coming in, they cut back on their expenses. So they were flush with cash, but they didn't have any place to put it other than the market. So people kept feeding the market, which is, a lot of what we've seen the increases going for here. So anyway, I thought I'd just mention that because I have so many people coming with cash, and where am I going to put it? Well, to your point, they're willing to take a little bit of risk and put it in the market like this.
Yeah, that's exactly right. In fact, we saw a lot of the stimulus money was saved last year. People weren't spending all of it, which is appropriate. The future is uncertain. When you get a sudden inflow of cash, you're going to save as much of it as you can. And also, as you said, Kelley, people weren't going on vacations. They were spending it in some other ways. We saw housing do well. We saw people spending on furniture and new pots and pans and new appliances. We saw those companies do very well. but it turned out they also saved a lot, and this was the place to go. Now, it's not like you have to steer clear entirely of the bond market. You know, in balance, some of the folks on this call are in our balance strategy. We actually have a very unique way of approaching the bond market. We hand select individual bonds, and even in investment grade, we're able to get, you know, 2.5%, 3-ish% yield, which again, when risk-free bonds are giving you 0, that's pretty good. So some folks still want some safety, right? As you have on your circle there with the 3 sections, still want some safety. So you can still, you know, be successful with a balanced strategy where you do have some bond exposure. But that's, again, to the question of, is the market expensive? The answer really is no, when you look at how low interest rates are. In fact, over the weekend, Warren Buffett of Berkshire Hathaway had his annual meeting. And one of the questions he got was, hey, you know, do you think stocks have run up too much? And, you know, Warren Buffett's a pretty conservative guy. I mean, generally, he's one of the first ones to say, you know, things are too expensive. And his answer was no, absolutely not. Look at where interest rates are. Interest rates are so low, you know, when you look at valuations, it's not surprising that we're where we are today. And that doesn't mean that it's not a good time to invest. In fact, he says just look for companies that generate a lot of cash, have good balance sheets, and can continue to work for you in the future. And that's what we do when we select those individual stocks. Okay, so let's put in context, though, where these multiples are, these price to earnings ratios, so that when you break the market apart into the stocks that did particularly well during the pandemic, the companies that benefited from people staying at home, right? Those companies are Microsoft, Facebook, Amazon, Apple, Netflix, Google. Tesla I threw on there because it just got added to the S&P late last year. These stocks are all trading at very, very high multiples. They're very expensive. And when you look over here at the forward price to earnings ratios of just that group, the Microsoft, Facebook, Amazon, Apple, Tesla, they're trading at 48 times next year's earnings. And the rest of the market's only trading at 16.2 times. And so the market isn't too expensive, especially when you take into account low interest rates. And secondly, when you look at the non-FANG or MFANG or MFANG plus Tesla stocks. So that's, again, a reason why we prefer to be able to look at individual stocks, and we can avoid the very expensive ones. Now, in this group, we like a few of them. The less expensive ones in particular, we like Google. We have that in most of the balance strategies. We like Microsoft. It's one of the things we added last year. At the very beginning of the pandemic, we recognized that while Microsoft was expensive when you look at its opportunities before the pandemic struck, once the pandemic was upon us and we saw how that was going to change people's use of computers, how it was going to change the demand for cloud computing, we recognized that all of a sudden Microsoft's opportunity got a lot bigger. And so we bought Microsoft very early on during the pandemic, and we think it's going to continue to do well. We also own Apple, for example. But these are among the 3 cheapest in terms of the price of the stocks relative to earnings. So Kelley did ask me to address some of the changes that we made. This might be a good time. I just told you we added Microsoft, but there are several others. We didn't add Amazon, even though we knew Amazon was going to be a beneficiary, but we did add Zebra. And Zebra is a company I've talked about before with you folks, and it's a company that enables Amazon because it provides the handheld barcode readers that are all over the Amazon warehouses. They also offer technology for tracking cold stored vaccines.
Oh.
And so the Pfizer and Moderna shipments, they have to be monitored to make sure that the temperature is maintained during shipping. They also work with the U.S. Postal Service. So they are very involved in shipping and logistics, and as well as very tied into Amazon. So in fact, Zebra has outperformed Amazon over the last 5 years, over the last 1 year, over the last 2 years, and it's still a lot cheaper than Amazon is. We were buying it originally back around when it was 14 times earnings. I think it's now double that. It's like 30 times earnings. But because of its growth prospects, it's still a very good stock to hold, we believe, and it's one of the has been a big beneficiary. But other things we added were Home Depot. We like the housing market. Obviously, folks moved, found bigger spaces. That was a good addition. We added Target because we saw that would be a good competitor to Amazon, and they had just enabled deliveries to home, and we knew they would do well no matter how long the pandemic lasted. Because remember, back in March and April of last year, we didn't know a vaccine was going to arrive so quickly. We didn't know how long this was going to be. We didn't know how bad this was going to be. So we wanted to buy things that would do well in either scenario, a long pandemic, an even longer one than we've had, and also ones that would be able to do well as the economy reopens. So Target, I think, has been a good purchase for us. Walgreens, we added Disney after they got really beat up. These are all things we added after they traded down. But we also had to sell things because we were owning companies that were really hurt by the pandemic. We did own some cruise lines. We did own some airlines, for example, and we had to sell out of those positions, particularly when they cut their dividends. And we just recognized that while they could eventually recover, it was going to take so long that we were better off moving the money out of those stocks into something that would benefit from the pandemic, like moving into Target.
Let me interrupt a little bit here because I want to highlight what exactly she's saying here for everyone listening. This is so brilliant. This is why I love Joanne and why I love Advisors Capital Management, because they were so nimble last year in seeing forward, if you will, looking, okay, we've got this pandemic. Yes, we've got some stuff that's gone down, and absolutely some portfolios were down last year at some point. And I called all of you and I walked you through what Advisors Capital Management team was doing to hold on, let them do what they're supposed to be doing. And I love that they're so nimble like this. They can get rid of things that they don't think are going to recover. They're going to go into stuff that they think that is going to recover. And when you have a group of mutual funds and you've got a manager managing mutual funds, they don't do any of that. I love that about what Advisors Capital does. So anyway, I'm sorry, Joanne, I just wanted to highlight and make a think of that.
Yeah, you know, we actually, I just looked at the list and counted. We actually bought 16 new positions last year between, you know, March and through the year, and then early this year. That is a level of change in the portfolio that is really unusual. We're long-term holders. We like to buy good companies for clients and hold them. But because there was such a disruption, because the opportunities were changing so dramatically for different kinds of companies, we had to make a lot of changes in the portfolio. Not typically something you'll see. That was about a third, 30 to 40% of the portfolio got turned over on the equity side. And that's, again, then I'm talking about balance because that's where most people are. But that's pretty unusual. Okay, so let's see. Another reason why we don't think the market is overvalued, and the reason why stocks have gone up so much, is because investors are forward-looking, right? They recognize that earnings were going to recover, and this here is a chart that shows you how much earnings growth developed over time. So this is from the first quarter of 2018 to the first quarter of 2021. This quarter, right, it was expected, and this was a few weeks ago, that earnings growth year over year would be 24%. So the fact that the stocks moved ahead of that was simply in recognition that this was likely to happen. And so the companies were worth more. Oh, hey, we're going to have 24% growth in earnings in the first quarter. That means I can buy those stocks now because I know they're going to deliver. And the expectation was pretty high. And in fact, the earnings that they've reported so far, we're about halfway through earnings season, are coming in ahead of these expectations. So companies are delivering even better results. You know, last year, though, notice that in the second quarter, earnings were down 7%. Or sorry, they were down 15%. And then in the second quarter of last year, earnings were down 32%. So again, stocks went down ahead of the drop in earnings last year. Right, they went down on March 23rd was the bottom, but then they immediately started to recover as the market started to become more forward-looking. But markets also look well beyond any one quarter. So again, this is what we're seeing in the first quarter, and it's uneven. Consumer discretionary is the first set of bars here. They're going to have a very good quarter because spending is coming back. Financials, the banks are doing much better because people are, starting to borrow again, and because They're doing so well on the trading front. So the banks are doing better. Banks are classically a reopening trade, and they do more business when the economy is open than when it's closed. And so everybody recognized that was likely to happen. And these are massive growth numbers, 72% year over year in the first quarter. That's because so much didn't happen last year. Materials, again, the economy stopped last year. So this year, earnings are picking up dramatically. Infotech was one of the areas that held up pretty well last year because of so many companies supplying into the needs of people working and living their lives at home. And then for the full year, energy doesn't show up because it had negative earnings last year, so you can't calculate the growth rate off of a negative number. But industrials likely to see a very strong comeback. Again, the economy reopening, more spending from consumer discretionary materials. So you can see that the market came up last year, not for no good reason. The market recovered last year and this last quarter because of investors looking forward to better earnings. And then next year, we're expecting to see even more growth because the economy is just starting to reopen. So, there's still not a lot of activity. Restaurants are still, operating at half capacity or less in some cases. They're all just starting to open, and we're in May. So we're only going to have a half a year's worth of really, better business in a lot of parts of the economy, which means in next year, in 2022, you're going to get a full year of the economy being open. And so you're going to get a big growth in earnings in so many different sectors because of that. So the market, again, is forward looking. We've seen stocks move in advance of when we see earnings actually delivered. And so, I don't think there's a reason at this point to be nervous about being invested or putting new money to work in the stock market because we have so much growth ahead of us. And we saw, for example, we're seeing the economy reopen. This is a chart that shows you the economic recovery is underway. These are different measures of economic activity from people buying people buying new houses, mortgages. They rebounded very quickly. Consumer credit transactions recovered very quickly. Hotel occupancy took a huge hit, down 75%, but it's starting to come back. Travel, again, this is measured by app usage, is starting to come back. The thing that had the worst time was restaurants. Seated diners was zero because restaurants were closed. And that's starting to come back, and more so now as we get to nicer weather and more people are vaccinated and restaurants can finally reopen. So the economy is reopening. We're seeing it in a lot of different measures. And we saw this hasn't been updated since the new number came out, but GDP growth last quarter was 6.4% at an annualized rate, which is almost unheard of. For the year, we're expecting GDP growth to be over 6%. And that's consumers are spending, government is spending, private companies are investing in new factories and new equipment. Imports are way up because consumers are out there spending and they're buying it from all over the world. And that's a very positive sign. The thing we have to worry about, though, a little bit is inflation. And so the CPI, Consumer Price Index, or the PCE price index is the one that the Federal Reserve watches. We're going to see inflation at around 2.2% this year, 2.6%, something like that. But it's not expected to go up and get out of control, right? The chairman of the Fed, Jay Powell, has been talking a lot about this. He acknowledges that, yeah, we're going to see a bit more inflation than we have, but we're comfortable with that. We actually want to see some price inflation, but it's something we need to keep our eyes on. And I'll talk a little bit about why later, how that affects our positioning in the portfolios. Housing market's very strong, and it's likely to continue to get stronger. So there's a lot of ways we think about the macro situation when we're selecting stocks for portfolios. Okay, so I just mentioned inflation. I won't hit that again, but the one concern that folks do have, and we get a lot of questions on this, is hey, the federal government is talking about a new infrastructure package. They're talking about that family care plan. That sounds like an awful lot of government spending. And so some people do ask, hey, should we be more worried about inflation? Well, it turns out that right now, there's so much slack in the economy. There's so many people unemployed, right? There's so much that we can get back to work that we shouldn't be so worried about, this, what some people call overheating. It's not an issue when you have 9 to 12 million people unemployed. They can come back to work. The infrastructure plan that's being discussed, for example, is not for spending all in 2021, right? It's infrastructure. It's roads, it's bridges, it's broadband, it's even education, right? It's what we call human capital over in the economics world, investing in the productive future of the country. And it's going to be spent over many years if something like it gets passed. So it's not going to create a lot of pressure on the economy right now. And so we're not so worried about inflation, but it is something to keep an eye on. Okay, so what did happen, and what kind of a situation are we in going forward? Well, this is a picture of the different indexes in the market, the different sectors. And so we saw a big difference in the first quarter. Energy stocks surged up 30% practically, financials up 15%. But the things that did well last year did less well here in the first quarter. And we saw more of that today with the technology sell-off we've seen over the last few days. But, they did extremely well last year, up 42%. And the year before that, up 48%. So, we're seeing a bit of a rotation. And that's, again, something that we're positioned for in the balanced strategy and also in the growth strategy. So these are the things that we look at to try to understand, how we need to position the portfolios. The other concern that folks talk about is in this rotation, what we saw last sort of for the beginning of this year was a real surge in what people call low quality stocks. These are high beta. This blue line here is the S&P 500 high beta index. And high beta is a volatile stock, right? And so they got crushed during the pandemic because they were lousy balance sheet companies, high debt. And what we saw was a rotation towards those companies. They did really well because they had so much more need to recover. And so sometimes when you look at the portfolio, you might see, like we saw last quarter, a little bit of underperformance because what we saw in the market was these really lousy quality companies surging and recovering after a particularly bad year. And, more steady Eddie kind of companies just sort of plodding a little bit higher. Okay, so, Kelley has told you that we're GARP investors, right? We like to get growth at a reasonable price. That's what GARP stands for, growth at a reasonable price. And so sometimes we get asked, what makes a price reasonable? And so the way I like to think about this and explain it is with the Google-Amazon comparison, right? Google is the company that's trading at about 25.8 times next year's earnings. And it's generating growth in earnings of about 20 to 25% a year. For the next 5 years, that's probably a pretty good estimate. Amazon is trading much higher. It's trading at almost 50 times earnings. And it's growing a little faster than Google, right? It's growing at maybe 25 to 35% over the next 5 years. But notice that the multiple is about double Google's, but the growth rate is not double Google's. And so why should I pay twice as much for something that isn't growing twice as fast? And that's the sense in which Amazon is expensive and Google is not. And that's what it means to be looking for growth at a reasonable price, is you've got to make sure you know what you're paying for. And so that's, one of the ways that we look at how to select stocks for the portfolio. Now, last year, we saw a big change in the stocks that did well and the types of investing, the styles that did well versus the styles that didn't do well. Last year, the best performers were momentum plays, like the Teslas and the Facebooks and Apple and Microsoft and some of the others. But this year, so far, year to date, value is the best performer. So those numbers there are percentage appreciation year to date. right? So last year, momentum stocks were up 30%. This year, value is up 18.5%. So in any one year, just look at how these colors move around. Cyclical was great in 2019, not so great in 2014, right? Value been great so far year to date, pretty lousy in 2019 and horrible last year. So that's why, another reason why we like to do individual stock investing. A lot of the times when you look at a mutual fund, you're buying a style. Okay, let me invest in that value mutual fund. Let me invest in the growth mutual fund, right? It locks you in and it doesn't allow you to be nimble enough to change what you own when market conditions, macroeconomic conditions, or sector opportunities change. And so that's, again, a reason why we like to look at selecting the individual stocks so we're not stuck, so that you guys aren't stuck in one of these buckets where you do well one year and then you bottom out the next year because you're stuck in a style. Now, I also like to warn folks that, you know, while we did see a nice recovery from the middle of March last year, one has to be prepared every year, right, to handle downdrafts in the market. So this slide shows you the number of times, that's what's hovering over these bars here, the number of times that the market, This is actually, this chart is telling you the average drop in a year between the low point, right? So in 2020, the low point in the market was when it dropped 34% down to March 23rd. But then the market ended up 16%, right? And so what you'll see is that almost every year, right, you have pretty serious drawdowns. In fact, if you were to count the number of years over the last 30 years, when the market at least one time fell 5%, it's almost every single year over those 30 years. And if you draw the line at 10%, it's about half the years where you're going to have to suffer through a market drop of 10%, right, in a given year. But notice all of the years where the market ended up for the year, right? And it's most of the time. And even when the market ends up down here in the early 2000s, we had 3 years in a row. But then we had 5 straight years of very good returns after that. You know, in 2008, the great financial crisis was a terrible year. But, you know, we had very good years after that. And so that sort of speaks to the value of long-term investing and of riding out these downdrafts. And you kind of have to have a little bit of an iron stomach to do it, or you have to be well diversified in the different types of investments: equities, bonds. Kelley has these alternatives, real estate, annuities.
Okay, so here's a question. So Joanne, what's the likelihood of the market going down something like 10,000 points or something sometime soon? Do you think that you're going to, now obviously you don't have a crystal ball, but you know, and a bomb can go off somewhere in the world, and we have such instantaneous news feeds these days that the market does react like that. But what do you feel like there's a big correction coming at all? Joanne? Did we lose her? Can you hear me, Joanne? Uh-oh. We lost Joanne. Can you hear her? Aaron, what do you think we should do? So you need to make her an attendant. She has her pictures on here.
Yeah, sure. She's probably just
She's pulling up the thing.
okay.
Should we tell her to go in and go out again?
She may have tried to join.
Unmute me? She's not muted.
Maybe try to make host.
Now she's muted.
She can unmute herself.
Can you hear me now?
There you go. Now I can hear you. Yay! I don't know what happened.
Yeah, I don't know. My phone hung up. Sorry about that.
That's okay. All right. You're going to share screen again?
Yeah, I just want to make sure I can hear you.
Okay.
Okay.
I can hear you, so that's good.
Sorry.
You know, it's always something.
Always something. Okay.
Okay, so my question, because I don't know if you heard it or not. So a question that came in, what do you think there's going to be a big downturn at some point, 10,000 points or something? I know you don't have a crystal ball, but something major going to happen anytime soon? Do you kind of feel that's going to happen and then we're going to be fine in the long run, or you don't really see that happening anytime soon?
Yeah, that's always hard to tell. That's why we advocate for being diversified and being comfortable in your allocation, equity, fixed, and other, but there are some risks, right, that we are monitoring. First of all, who could have ever seen a pandemic coming? That was obviously a big risk, but I will remind people to remember this chart. Okay, it was horrible, but look how fast we recovered.
Yeah.
So even if we run into something like a pandemic, it's pretty remarkable what happened. Now, Alan Greenspan, as you know, is one of our advisors on our board. He has written recently about the concern about the federal debt, right? And we do have a high level of debt. The new programs ostensibly will be paid for with higher taxes, and I know there are a lot of concerns about that. We can talk about that. But fortunately, borrowing is very cheap right now. And it's very cheap for the government to borrow especially. So right now, in terms of the amount of debt the US has relative to its GDP, it's not at all alarming. It's not concerning at all. The concern is we can't keep running deficits year after year after year at the level we have been. We have to stop doing that. So that is a risk. We have to have the political will to be able to pay for any new spending with taxes. So that's a risk, one risk. A second risk is that inflation is going to go up. It's going to go towards 2. It's probably going to go past 2%. We should expect interest rates to rise. And that means that, particularly with interest rates, the stocks that have very high multiples, what those stocks are basically a willingness by investors to pay not for the earnings a company is generating now, but the earnings it'll generate in the future. And so how much is an extra $100 of earnings worth 5 years from now? Well, it's worth a heck of a lot more if the interest rate is 0 than if the interest rate is, say, 5%. So higher interest rates reduce the multiple on high-flying, high-multiple stocks. So you have to worry about the Amazons of the world, the Teslas of the world, the Facebooks of the world, that those stocks in particular could be hurt as interest rates go up. We could see a major correction in some of those high multiple stocks if and when interest rates rise. So it's not so much that I would predict a major reset of the entire market. It's more, I'm more concerned about the risk to multiples of some high flyer stocks that did so well last year. A big market-wide correction can come along at any time. We've seen them over the years. In fact, let me scroll back down here. mean, that's what these are, right? Anything below 10%, 20% is so-called bear market. Well, we've had, 1, 2, 3, 4, 5, 6, let's call 19% a bear, 7, 8, 9. We've had 9 in the last 30 years. So a third of the time, there will be a bear market in any year, right? A third of those 30 years we've had a bear market. Oh, sorry, 40 years. So a quarter of the time. So they're regular, in other words. So yeah, the question is, will there be one? Probably. Will there be one in the next 4 years? Almost certainly, given that they tend to happen 1 out of 4 years.
Yeah, well, and I love the way you guys managed through that. I mean, you were proof positive of that last year with exactly what you do. I watched you do it. So you guys are very nimble. And again, this is why I like them buying individual stocks rather than mutual funds or something else. One thing, I wanted a couple things, and then there's another question. And I don't like debt. Don't get me wrong. I don't want anybody to take this in the wrong way. But I was at a conference recently, actually a live conference, if you can believe it. It was really fun to go with people in the room. Anyway, the national debt is about 23 trillion. The national assets, which a lot of people don't think about that in conjunction with national debt, but the national assets, and that's land, buildings, the US Treasury, real estate, taxes, gold, dams, mineral energy leases, those are kind of the US assets, if you will, is 269 trillion. So 269 trillion of assets, 23 trillion of debt. Again, don't take this wrong. I don't like debt. I'm not saying it is, but it's interesting to see, as far as leverage goes, if you're going to look at it in a traditional sense, it's maybe doesn't look as bad, even though, yes, I don't like the debt. I don't like them increasing taxes and all of that. So anyway, it was just an interesting aside. All right, Joanne, let's ask you this question.
Kelley, add another thing. I bet those assets aren't counting the value of the labor force, the human capital.
Yeah, probably not. Yeah,
right.
yeah. Okay, I got a couple of questions for you. What happens if China invades Taiwan after the Beijing Olympics and China confiscated the Taiwanese microchip manufacturing? What will happen to the technology sector? Any thoughts about that?
We actually talk about that quite a bit.
Yeah.
That was one of the risks I was going to mention, is geopolitical risks. And obviously China is causing some concern. If folks watch 60 Minutes, for example, this past Sunday, there was a segment on the China situation with the Secretary of State Blinken, and he remarked that he has not seen China be either this repressive internally or this aggressive externally ever before. So they definitely are a concern. So again, geopolitical risk includes China, and they've been doing a lot of military maneuvers around Taiwan. So it's a concern. The question is, you can ask this question a number of ways. One, we can step back and say, we cannot predict whether China is going to invade Taiwan. Do we want to prepare for that in the portfolio? Well, we should probably try to put some probability on it, right? Well, one thing we already have in the portfolio is we do have exposure to defense companies, right? So Raytheon, Lockheed Martin, these will obviously do well if there's a military maneuver of that scale. But the second thing is, and we have other companies, but you do have to try to assess the probability. And so then you have to basically try to put yourself in the head of China. And one thing we do know about China is they like to play the long game. And it would probably be a pretty short game if they tried to invade Taiwan, because I don't think the US would stay out of that. We have too much vested interest in Taiwan. One of them being Taiwan Semiconductor Company, TSMC, which is basically the factory to the world of semiconductors. It is such a major provider of chips that go into everything from your, just look around your space that you're sitting in, right? How many chips are around you in your room? You've got monitors, a computer, lights, thermostats, televisions, appliances. I mean, chips are in everything, cars, obviously. So there would really be no way for the Western world to stand by if China invaded Taiwan. And that means all-out war. And China knows that. And again, since China really is known and communicates quite clearly that they play a longer game, it's very unlikely that there would be a military confrontation of that scale. Now, the US isn't content, though, to just keep hoping that that's the case, which is why the US government is working very hard now to subsidize the creation of more semiconductor manufacturing in this country. We already have some. We have beyond Intel. We have Taiwan Semi actually has a location in Arizona. Samsung has locations in Texas. We have numerous fabs. We have fabs in upstate New York, Vermont, Colorado. There's actually quite a lot of semiconductor manufacturing. It's still a small percentage, though, ultimately, of all the chips that we end up using in the stuff we buy in this country. And you can see it happening globally. Europe is also focused on now subsidizing the creation of semiconductor manufacturing there. And there's already some there. But it's a concern. It just doesn't seem likely that there'd be a full-out military confrontation because it's such a strategic asset to the world that the world, I think, has made clear, the US and Western allies have made clear that we wouldn't stand by if China were to invade Taiwan.
Okay, let me shift gears slightly here. Another question that came in. Do you tend to migrate to large cash positions during the bear markets, or do you hedge with other types of investments?
You know, the market capitalization size of the company per se is not that critical. It's the health of the balance sheet matters far more. And so, for example, we did switch from Exxon to Chevron, both big companies, but Chevron had a much better balance sheet. And so we made that switch. But we also bought Zebra, which is relatively small. So it really is the quality of the management, the quality of the balance sheet, and then what we're looking for, exposure to the things that are going to do well, you know, throughout the crisis, whatever the crisis happens to be. So it isn't market cap per se. It's generally we look for quality of the balance sheet and exposure to the right drivers.
Yeah, so you guys are not really in cash very often, it sounds like.
No, we're not in cash. There will be times where, you know, we'll trim back or something, or we will hold some extra cash because we want to be able to take advantage of certain stocks selling off. And we know if we have like 4% cash, then we can jump in and take advantage. And we did that somewhat over the last year. We did have some elevated cash for a while.
Okay. Good.
Do you want me to touch on the whole capital gains tax question? Because we get that
why
a lot.
don't you? Because I know that's on a lot of investors' minds.
Yeah, it comes up a lot. You know, there's two parts of the question. One is, how is this going to affect me, right? How is it going to affect an individual investor? And then how is it going to affect the investing environment, right? So if let's just suppose if the capital gains tax gets raised as described and the step up in cost basis go away, we could see folks want to move ahead of that. Now, they can't do anything about the step up, but they can do something about the capital gains, and they might want to sell out of stocks that have had a lot of accumulated gains. That's another reason for us to be concerned about owning things that have very high multiples and have roared higher very quickly, because it's more likely that people have concentrated positions that are too big with lots of capital gains, and they're going to want to trim those. Right. And so, but that's a short-term problem, right? Once folks reallocate, once they capture their gains and they move on, they're going to buy something else, and those things will go up in price. And then eventually the appreciation going forward goes back to in line with fundamentals, and fundamentals are earnings growth and prospects and all that kind of thing. So the effect of folks wanting to get ahead of a tax cut is a temporary one. That's something we would ride out. But it is something where we think the bigger vulnerability is in the higher multiple stocks that have been the most in the momentum play recently. The longer term effect is really nothing. You know, the higher capital gains tax doesn't affect a company's ability to grow, to generate earnings, and so therefore to generate more value over time. And so the appreciation of any one stock, you know, really isn't affected by how high the capital gains tax is. The corporate tax rate would be a bigger issue, but it sounds like the corporate tax rate, if anything, will go from maybe 21% to 25%, it'll be asymmetric across companies, and so we'll be, careful to watch out for that. But as painful as such a change might be for individual investors, the folks that fall into that category are only 0.3% of the investing population. So it's unfortunately for those that are in that well, not so unfortunately, it means you're making more than $1 million a year. That's not too bad, but it's going to lead to some painful reallocations. But that's a short-term effect on the market. It's a short-term effect on the investing environment, and that's the kind of thing that we might see on this screen over here that you can look at. We might get drawdowns, particularly in certain stocks of double-digit percentages. But then we could end up the year up like we did in many of the years after the crisis and before.
Makes sense. Okay, anything else you wanted to cover?
No, just wanted to remind folks that those income stocks still have a ways to go before they completely recover. We're getting there. And so folks that are in more income-oriented strategies, whether that's the T4 sleeve of balance or the T5 balance, or maybe they're in income with growth, we still have a ways to come back. Those still might be some of the best performing stocks going forward, right? We're seeing already a bit of a rotation out of tech and into value. We'll see some more of that. We still want to, retain our exposure to tech because we have multi-year drivers there, whether it's 5G cellular, whether it's continuing growth of data centers, the housing market we think is still strong, and there's a number of plays there. So, the income-oriented investor, though, should expect to see further recovery and a reinstatement of dividends and an increase in dividends for companies that had to cut them during the pandemic. And so we are optimistic about the income-oriented strategies going forward in particular.
Yeah, good to know. Yeah, I have a number of clients on the call here with you tonight that are looking for more dividend paying types of portfolios. So that's good news. That's really good news. Okay.
Yeah, I mean, we can get 4%-ish gross yield in our T4. You're giving up some appreciation to do that, generally speaking. Again, this year it might be different because of the dividend stocks lagging. In our T5 sleeve, we're getting a gross yield of just under 5%. Again, there's a trade-off. There always is. But you can find some very good dividend pairs. REITs are coming back. The banks are still, have more room to recover. So there's still a lot of room here for income to help people. Again, some people sleep better at night knowing that they're kicking off those dividend yields, and they don't have to worry that they have to sell a stock to pay their bills.
Yeah, exactly. Yeah. Okay. Anything else you want to add?
No. Well, actually, hold on. I should probably, they like me to show the last slide, which has disclosures on it. There they are. Read them fast. No, but Kelley has this presentation, and she can share it with you guys. No, I'm happy to have had the opportunity to talk to you folks. And Kelley, if you get more questions, you know how to find me.
I do. Well, thank you so much, Joanne. I really appreciate it. Just so you all know, I am recording this, so we will have it up on the website, or if anybody wants to see it again, I can probably send it to you.